The star Wedbush analyst, he covers Lyft. He has an outperform rating and a $17 price target. Wow. Okay. Yeah. What's your reaction?
I mean, Lyft continues to be the little brother to Uber. And I think this is a dog ate the homework type situation in terms of what we're seeing from an EBITDA perspective. We got to evaluate what happens in the call. Our view is stock was way overdone. It's obviously had a huge rally to date. I still believe Uber is the best way to ultimately play rideshare. And for Lyft here, I mean, this is a fork in the road in terms of this quarter, the next quarter. Can they navigate and do it profitably?
What leads you to believe in any way, shape, or form that they can do that? I'm just not going to let you off the hook that easy.
Sure. I mean, because our view is that we are seeing a massive recovery in terms of just overall rideshare. Drivers come back, and that's been a big issue from a supply perspective. Now it comes back to the heavy liftings ahead for Lyft. Uber's already done it. Dara's sitting there with champagne popping, watching these Lyft numbers because of what Uber's done. Lyft, now they need to be able to do this. Otherwise,
well, do they not have the things that they don't have the same levers that Uber has? They don't have the Eats business.'re not global. You don't have free money. You can't burn cash like you could in the past in that environment. What's the pushback on that?
Yeah, and I think now it's really, can they be able to navigate a profitable rideshare business domestically? Clearly, they don't have the levers that Uber has. But I think a lot of this, Scott, has really been execution. I mean, even like what Deirdre was talking about, management team being surprised by what you see in terms of a supply. Uber saw that from a mile away.
So Brad Gerstner, who is a big Uber investor, said this as an industry, okay, the ride-sharing industry is a winner-take-most business at this point. And Uber is the one that is going to take the most. You agree with that?
Oh, 100%. Couldn't agree with Brad more.
Okay. So how in you-know-what's name can you have an outperform rating on Lyft if you believe what you do about Uber? I don't get it.
It's relative to what valuations was, if I look back over the last 4 or 5 months, to where I believe Lyft was way oversold. Stocks had a huge rebound here. But like we've even told investors, this was a pivotal quarter for them to navigate. And if they ultimately cannot get through these next few quarters from an EBITDA profitability, then the story changes. To date, I think it's been a nice, significant sort of oversold rally that we've seen. But just like you were talking about, you need to prove it in numbers. We've seen a better than feared earnings season across the board, but clearly there's going to be ones that fall by the wayside.
So as you sit here with me right now, you're not thinking like, okay, I need to go back and seriously get out the pencil and think about downgrading this stock, because outperform and the target that you have of 17 doesn't feel real good for the people who are watching and may own this stock.
Yeah, I think a lot of it really comes down to we're still confident on the overall opportunity in terms of rideshare, but this call in terms of sharpening the pencils, how they ultimately give comfort. Just go back to, let's say, Apple. Aftermarket stock sold up big. The Hall of Famer Cook gave the ultimate confidence, and that's why that stock is where it is today. Lyft, this is a confidence call that they need to do. Otherwise, there's going to be some darker days ahead.
But I'm just trying to figure out what could they possibly tell you? It seems like a fundamental situation. As you said, the little brother to Uber. The stories seem at this point so disconnected. One is profitable. One has no, pardon the pun, road to profitability in sight, it seems.
Yeah, it seems. And that's really going to be the call with the focus. Can they ultimately, as they get into the second half of the year, what does the profitability look like? Is this sort of a one-quarter issue that ultimately hurt profitability? If they give that confidence, then we can see this thing recover, as we've seen with aftermarket moves.
So, I mean, I don't own Lyft or Uber, and both companies have been horrible investments the last 5 years. I mean, Lyft is down 60% over the last 5 years. Uber's down 11. I don't think Uber's ever still gotten over its IPO price. And so I think when you have this duopoly, both companies are incredibly labor intensive. They're never going to get rid of the drivers. And so I don't think they have that much operating efficiency and leverage. And to me, it's like these are good examples of two great companies. We all love the experience. But to me, it's more like a Peloton, where it's a great company. You could even have great management, but that doesn't always translate into a great stock. And so for that, it's like, I think neither one of them have earnings. And so 5 years is a long time. The S&P's at 57. They're both down significantly. I think it's like you have to question the space as well as a stock and separate those from the company themselves.
So how do you respond to that?
It's a penalty box space, but I will say that Uber, the story's changed dramatically. In other words, that was more of what I view as almost a Jalen Hurts-like type quarter and guidance relative to going forward. And that's why I think Uber, better days ahead. Lyft, clearly in the penalty box. This is a key moment for them to sort of prove themselves.